Welcome in. We're going to talk a little bit about individual stocks versus having a more diversified portfolio of index or ETF funds. And what we're really going to focus on here is Morgan Housel's book, Psychology of Money. I think we've mentioned this a few times and used some of the resources that you can find in the book. I do think it's probably the best book written on finance, personal finance in the past 20 years or so. Highly recommend it. And what we're going to talk about today is a specific chapter in the book where Morgan Housel breaks down what happens in stock market returns and really the distribution of returns. So whenever you see that, let's say the S&P 500, and let's say that we have a year that the S&P 500 makes 22% in 1 year, really great return. More times than not, the way that the S&P 500 gets to a really fantastic 22% return is not that most of the companies, of the 500 companies, it's not that most of those companies have great years. More times than not, the results, the end return of the S&P 500 is because of a very small portion of companies. And we'll actually cut to the chase at the end of this video. We'll talk about this a little more. But this is 1980 to 2014. And this data is from JP Morgan. And it follows the Russell 3000. So really large index of U.S. stocks, about 3,000 U.S. stocks, publicly traded companies. And this was an incredible period for the Russell 3000. And, you know, we'll just put the return right here. The index 73x'd during this 24-year period. And so during this time, we see an unbelievable return, incredible compound effects. Wealth is just moving at a rate that, you know, anyone would be excited about. If you invest $1 million and you get $73 million, a little more than a generation later, a decade and 2 decades and a half later, you're going to be pretty excited about a 73x. A million turns into 73 million. Now, again, that does not happen because most of the stocks in the Russell 3000 did really well. In fact, only 7% of those stocks had really extreme great returns. And those 7% are the reason why the return was so good. But the difficulty is, and this goes into, should you pick individual stocks, or should you have exposure to thousands of companies? And, you know, we'll just cut to the chase right now. We firmly believe your portfolio must have thousands of stocks. It is not an appropriate investment long-term to try and pick 40 or 50 winners. It's really common. We see statements all the time from wirehouses and different firms where a investment firm has picked a strategy, maybe it's a dividend-focused strategy, and they pick 50 high dividend-paying companies, and they just invest in those 50 stocks, and they think that that's diversified. We would look at that and say, every bit of research, every bit of academic evidence over the past 50, 100 years says that that is emphatically not true, and that should not be your portfolio. You should not have a list of 50 individual stocks, not even 100 individual stocks. You should have exposure to thousands of publicly traded companies. So let's dive into what happened during this period. All right, so we're looking at 1980 to 2014. So we have a 2.5 decade long time period. And again, this is an exceptionally successful time period. The Russell 3000, 73 X's during this time period. But what's interesting is just how much failure there was. And if you've read Psychology of Money, you know that one of the most fascinating parts of the book is talking about different investments. And whether it's venture capital, whether it's private equity, or one of the most compelling examples is art. If you want to invest in art, art is a very difficult thing to invest in and difficult to invest successfully in, because when you look at a portfolio that just creates mega wealth over a long period of time, oftentimes the purchaser, the investor in art, they probably bought thousands or even tens of thousands of pieces of art. And of those tens of thousands of pieces of art that they purchase, well, maybe there's 12 of them that 30, 40, 50 years later, after the artist has passed away, they have just grown in unimaginable value. And so if you have a portfolio of art that's now worth hundreds of millions of dollars, more times than not, it's usually not a scenario where the original purchaser, maybe 50 years ago, got really lucky and picked the right 6 pieces. And those 6 pieces of art just turned out to be absolutely perfect investments, and they exploded in value, and the whole world wants those. More times than not, it's go back 50, 60 years, and during the accumulation process, when they were purchasing art, well, they purchased thousands of different pieces of art. And of those thousands of pieces, what do you know? 5 or 6 of them end up being worth $100 million each. And so that is very true with venture capital. It's very true with private equity. And a lot of people don't realize that's exactly how the stock market works as well. So again, when you see the S&P 500 have an incredible year, it's up 38%, it's up 18%, whatever it is. Oftentimes, and of recent example, I think everyone watching this can resonate. If you look at some of the incredible years in stock market history, whether it's 2020, especially the second half of 2020, obviously, or some of the 2010s years that were double-digit, huge growth years, a lot of that growth was not because 400 of the 500 companies had great years. It was because of FANG, Facebook, Apple, Amazon, Netflix, Google. It was because of a small group of tech stocks that were producing the vast majority of returns. So what we want to focus on here is the potential negative side of an investment. So again, the Russell 3000 at 73x during this time period. But of the Russell 3000, about 3,000 publicly traded companies, 40% of them experienced catastrophic loss. And if we look into individual sectors, technology, over half of the tech companies during this period had such a terrible time. They either went out of business, filed bankruptcy, they're no longer operating today, or they had a catastrophic loss. Even on this other end, a lot of people see utilities and think it's ultra safe, ultra secure. And yes, this picture certainly gives you a really great, visual example that, well, utilities are drastically safer than some of these other industries. But even in utilities, imagine explaining that what's widely known all over the world, utilities are known as the safest sector. In any market condition, they are needed. So we would expect these businesses to endure and last. But even in this field, we're looking at more than 1 out of every 10 publicly traded stocks that you could have purchased in this sector. More than 1 out of every 10 had a catastrophic loss. So if you're going to buy individual stocks, you need to understand that, one, the individual stocks that you pick are likely not going to be the 7% winners. 93% of stocks that you can purchase in this Russell 3000 index, 93% were not mega extreme winners. They were not tail event winners. And 40% of them experienced a catastrophic loss. So if you're going to buy individual equities, it's important to understand just how dangerous that can be over long periods of time. Now, that might lead you to say, well, I have 40 or 50 individual stocks now, but I'm going to know. Or maybe you think my advisor, my investment firm is going to magically know when we should sell them and when those stocks are about to fall off a cliff, and we'll simply sell them before that happens and then buy 40 or 50 new ones. And we're going to magically pick the 7% that are poised and ready to take off. That is completely impossible. And every bit of evidence and research shows that no one can successfully predict which companies are going to take off and which companies are going to fall off a cliff over long periods of time. It's impossible to be correct on that over and over and over. John Bogle, founder of Vanguard, he would use the illustration. We know that the stock market is really, the long-term gains come from a small portion of companies. They're needles in a haystack. And instead of trying to pick out needles in a haystack, why don't we just buy the whole haystack? And Russell 3000 during this period, incredible example. The only way that you got that 73x return was by owning the index, was by owning everything. You had to own 3,000 companies in a market-weighted manner in order to achieve this. So incredible lesson. We'll do more on psychology of money. And again, fantastic book. Highly recommend it.